Welcome to the Liquidity Event, a show about all things personal finance with a laser focus on taxes, financial independence, and equity compensation. Hosted by AJ and Shane of Brooklyn FI, each episode will focus on a personal finance topic, some driven by news headlines and sometimes driven by listener questions. And sometimes you'll just get two money nerds rambling about what they think is interesting. Just a quick note before we get started, this podcast is for informational purposes only and should not be considered tax or investment advice.
Hello, and welcome to the Liquidity Event. I'm your host, AJ Ayers.
And I'm Shane Mason.
And this is episode 146, being recorded on May 15th, 2025, airing on May 16th. A quick reminder for your listeners, we will answer your questions on the pod if you leave us a message. You can disguise your voice, use a fake name if you're shy. That link is memo.fm/the liquidity event. Today on the show, we've got tax law changes again, spies in FinTech, some corporate espionage going on, and a listener question about the end of the world. How are you doing today, Mr. Shane Mason?
I'm great. I'm in your house.
Yes, you're you're in the other room. You got a gold record behind you. What'd you win?
The call is coming from inside of the house. Yeah, I got a record for the biggest bullshit. I don't know. Is that a gold record?
Yeah, it's
I'm in Nabil. Oh, all right. I'm in AJ's husband's office in the house with his incredible setup here. Although the monitor's a little small. What's this guy up to?
He's
keeping
creative.
it tiny, keeping it analog.
Why don't you pull a record off the shelf and tell us about it?
Yeah, all right, I got you. This here is from Sly and the Family Stone. Actually, that's pretty sick. That was random. Man, I got lucky. This would be fun one to put on for the podcast. Maybe we should use this for our intro music today.
Should we just start the podcast with pulling a record off the shelf?
Nabil's gonna notice that I pulled it off.
Oh yeah, Nabil notices when I open a cabinet door and take a Band-Aid. Well, it's good to have you in New York City, bud, as always.
Yeah.
I think I'm sick of talking about tax bill updates, but we got to talk about it. But before we get there, I do want to talk about this information article. The title is Spies Are Everywhere in Cutthroat FinTech Industry. We've talked about this before on the pod. The big headline case being between Deel, D-E-E-L, and Rippling, two juggernauts in the HR software company employee benefits space. Interesting thing about these two companies is it's not like a David and Goliath kind of thing. Like, these two companies are both valued at around, depending on who you ask and what day, between 12 and 15 billion. So they're kind of similar, and kind of in this era where, your tech and your IP and your speed are really going to be what's going to set you apart from your competitors, not your funding, right? When you're getting off the ground, it's like, who's going to have access to the most capital? These are fully mature built companies, and right now it really is your innovation. So these corporate secrets are potentially bringing down their competitors. So that's why there's all these nasty lawsuits. Employee works at Rippling, goes to Deel, is accused of stealing secrets and sharing them with with their competitor. Thoughts on this article?
Yeah, I don't know. It sounds fun, honestly, to be a corporate spy. Like, I think you get a lot of the spying done without the risk of getting killed in a honeypot situation. Although the honeypot situation was always a very attractive way to go out for me. The honeypot. You know what this is?
Yes,
right.
I'm familiar.
But it was really interesting the way the most recent honeypot I saw was in Munich, that movie about the Jewish revenge for the Olympic massacre, assassination of Jewish athletes, which was really, really great movie. Anyway, any other news from 2009, I'll let you know. Some cool stuff from this article was like the way that they caught the people via the Slack channels. Apparently, I didn't know this, but you can preview a Slack channel just to see what's going on in it without actually joining the Slack channel. And there was some monitoring of the previewing, as well as when somebody was hooking up a cell phone, there was access to a database of text messages and call logs that could be viewed via forensic examination.
Hell yeah.
Slack, what's going on, man? Can y'all see my text messages when I get on Slack? I don't know. I don't have much else to add here besides it sounds cool. I mean, I guess there's the other, Brex and Ramp are also fighting it out as well as deal. One other thing I will say is that there's no what is it? No news is all news is there's no such thing as bad news. No such thing as bad news. I started noticing the deal billboards all over Silicon Valley.
No such thing as bad PR is what you're
there. It
meant
is
to say.
Yeah. Anyway, I didn't know what deal was before. I think I just seen their billboards and been like,
and
okay,
now you
whatever.
know.
I don't know what the hell that is. Yeah, now that I noticed when I landed in JFK the other day, there was a ton of deal ads all over JFK. And I'm like, I know what's going on here.
Right.
So it's like awareness is available.
That's the HR. Yeah. The other thing I want to say about this is remote work, right? When you're working remotely, it's a lot harder to do corporate espionage when you're sitting on the same floor as someone, or you're in an office with someone. It's a little harder to hide your screen, or, it's harder to hide your emotions if you're doing something sketchy. Whereas if you're working from home, all you have to do is log into, one 15-minute stand-up meeting in the morning. It's very easy to just do whatever you want. I mean, we think about this with our own team, right? We have tons of sensitive client data. We monitor our employees' actions very carefully. People are on Zoom all the time. We want to see where they're at. Working from home means working from somewhere secure. We don't just let people roll up to a hotel lobby and log onto the public Wi-Fi. Like, that's not available. Whereas it's very hard to monitor that in a company where you have thousands of employees. So remote work, secure. I think, cybersecurity, someone smart said this to me in the past week or two. I think I was with you. I don't remember who it was just like the next great threat to most industries is going to be cybersecurity and phishing attacks. Like, that's what's going to bring down small, medium sized businesses who just can't afford the cybersecurity consultant or are just vulnerable because they don't know better. And it's expensive to invest in that kind of security. So, non-competes also, wanted to talk about that. Non-competes are hard to enforce, but all of these companies are in lawsuits right now. They're all suing each other. And this idea of a non-compete, which got struck down in California, now there's this new Florida law coming up through the courts with a 4-year non-compete that Ken Griffin's trying to push through. So that's all I want to say about that. Speaking of laws, we have a big, beautiful bill, the House GOP tax plan. We have some preliminary details and analysis. We're tax nerds. We like to talk about this stuff whenever we can, but reader, listener, this is all draft. This is a rough draft we have right now. So what we're going to talk about is not necessarily going to become law. Me, Shane, my favorite thing in all of financial planning, 529 plans. So the little tiny thing I want to cherry pick out of this 398-page bill is that there, as I have predicted for years, there is now an expansion of the uses of funds of your 529 plans. You can use them potentially, and this applies to you, my friend, you can use them potentially for secondary education and certification programs. So if you are a CPA or a CFP or an enrolled agent or a certified equity professional or registered life planner or a CPWA or what's the other one? What are you getting? Your CFA, any of these things. Oh, sorry, I blew up your spot. Never mind. I meant C whatever. CGA. You can use
sometime in 2030. I'll be getting the CFA. Yes.
You can use your $529 to pay for these certification programs. So that was my big takeaway from this bill. That's going to increase our federal deficit by $4 or $5 trillion. And basically keep all of the tax cuts that we got from the tax cuts and Jobs Act from 2018. It's going to make them permanent. Those are the big takeaways. What you got for me, Mr. Tax Man?
Yeah, as a tax man, let's see what we have here. There's quite a few things going on here. There's a lot of it is just making the huge tax cuts from 2017 permanent. The reason they couldn't become permanent the first time around is because the cuts were so large that we have essentially stopgaps or limits on, you can't just make all taxes go away. You can't just cut all taxes to zero and defund the entire government. So we have these things that that had to go through a reconciliation process, which we're not going to get into on today's podcast. You can go back to 2018 when we discussed that the first time around. But there are some things that I love in here, like making the standard deduction a little bit bigger and permanent. It just makes taxes a lot simpler. Before TCJA, something like 40% of all taxpayers had to itemize their deductions. And after TCJA, it's only like 10% need to itemize their deductions, which means you just don't have to worry about tracking your union dues if you're in a union, a lot of the state and local income tax stuff that you were tracking before. There was just like a lot of opportunities for you to miss a deduction. So it just made lives easier for taxpayers as well as for CPAs, frankly, like being selfish. Like we just got to focus on tax planning rather than collecting every little receipt for your real estate tax bill. With that said, there are some cool things in here. Some of the other things that are made permanent are the alternative minimum tax is a lot harder to trigger. Mortgage insurance premiums, unfortunately, those were kind of slashed. I think a lot of that has to do with that, like red versus blue. People usually in blue states have a lot bigger mortgage insurance.
Just to double click on that a little bit.
Interest. Yeah.
Yeah, so it used to be that you could deduct as much of your mortgage interest as your house was worth, right? So if you had a $2 million house, you had a fairly significant interest deduction. Now, since 2017, we've had that cap at $750,000. Now, if you live in a major metropolitan city, your mortgage is probably more than $750,000. So that really limited the ability for the middle upper class to get that break. It made home ownership actually less attractive for those more expensive houses. I'm not mad at that mortgage interest cap. I just think it needs to be indexed for inflation in a more dramatic way. I just think $750,000 is too low. That's my opinion.
Yeah, and there's like some conflation of the mortgage insurance versus interest that's happening, but essentially we're talking about interest, and like there is an ability.
Did I say insurance?
I said insurance first.
Oh, okay.
Anyway, just to be clear with all of our listeners, like this is just a preview. This is just come out of the House Ways and Means Committee. By the time this comes out, this could have passed the House and be up to the Senate, which, with the Republicans controlling all three houses of I don't know about all three branches, but both houses of Congress and, the presidency, then there's a large chance that there won't be significant changes to this bill before it gets to the president's desk. So it is a preview and things are going to change. But one other interesting thing is the SALT cap. AJ, I think you and I were talking about the SALT cap yesterday, like this whole PTET thing. And this is, again, one of those other things that were designed to punish blue states wherein high-income taxpayers that typically vote Democratic have very large state and local income tax bills. If you make $500K in New York, you have about a $50,000 deduction for state and local income taxes, but that was capped at $10,000. So $40,000 of expense that you have is no longer tax deductible, to oversimplify. This expands the deduction potentially up to $30,000 with some sort of phase out over $400K. am I reading that right?
Yeah, that's how I read it too. So it's going to help you out if you fit into that kind of narrow income, into that narrow earning bucket of you're making less than $400,000 as a couple. So you're paying a lot of tax, right? You're probably in the 32% bracket at that point, at your top bracket. But if you make more than $400,000, you're paying a lot more in state and local income taxes, you're still not going to be able to take that deduction. So for our clients, this might help them, but our clients are such high earners that I think the SALT cap still is going to be salt in the wounds, as it were.
Yeah, and then like in terms of provisions that do not apply to our listeners or the other advisors listening to this, but are still big promises from the administration during the campaign, we have no tax on tips. This will be so easy to implement. Let's see if this one makes it through the House. I got 4 paragraphs from the Journal of Accountancy on how this is going to be expressed. By the way, AJ, I'll take all my partnership distributions in the form of tips in 2026. Yeah. Yes, I appreciate
I think we should.
that.
I actually have an email drafted to our clients about how their fees are all going down, and half of them are going to be paid to us in tips if we do a good job.
Yes, we are no longer a financial advisory RIA, registered investment advisory firm. We are now a restaurant that
we are a luxury hospitality brand for lifestyle improvement.
Yes, exactly. We'll sell you one peanut that has a 70-page PDF that happens to, as a menu of financial options available to you. And when you pay us $10 for the peanut, you can also tip us for the financial plan along the side there. Including in any investment management, tax loss harvesting that we do for you. That's all optional, but we strongly encourage a 40%, 4,000%. Can't wait to flip the iPad around.
Flip the iPad. Well, yeah, I mean, we talked about tipping so much, was it last week or the week before? So it's like, is that going to encourage us to tip less? Like, am I now going to move into the 18% tip bracket because I know it's not getting taxed? So maybe, I don't know. I'm still thinking through that one from my perspective as a tipper as opposed to a wage earner. I mean, honestly, my fear with my immediate reaction is that employers of these type of workers are going to slash wages, right? So like, oh, well, your tips aren't taxable anymore. So, your wage, you were getting $25 an hour. Well, I'm going to slash that down to $19 an hour because now your tips are not taxable. So you basically got a 25% raise because now you don't have to pay tax on your tips. So I don't like the potential behavioral changes for business owners that this might cause. So that's me speculating, but that's what I would do if I needed to increase my profit margin.
Yeah, all of this is just distractions from the fact that the wealthiest people in America don't pay their fair share. If we just had Mitt Romney paying 30% income tax instead of 12%, and the folks like him, you know, the capitalist class, the wealth class, the people that are exchanging their income comes in the forms of capital gains, which are taxed at 0% and 15%, and then if we're lucky, 23%. If they're in the top bracket, and if they've actually worked, then they'll be taxed at 23%. And this no tax on tips, all this hoopla and this complication, like it would be we could close the tax gap by taxing the rich and then funneling that money down to people that need the help. Like, I don't know, this is ridiculous, but
yeah, I mean, look, Shane, have you ever seen, you know, people smarter than us who are, you know, tax lawyers who've been doing this for decades? Have you seen anyone talk intelligently about increasing the capital gains tax? Because from where I'm sitting, what I've seen based on like our client base, you know, our clients will have giant capital gains, you know, 5, 10, $15 million in 1 year, which is great. I have this notion that there should be sort of this like lifetime exclusion. So like, you know, people have liquidity events, people have one-time, you know, amazing exits. They should have the opportunity to keep the current capital gains rates, you know, up to 23% for up to $10 million. And then after that, let's tax it like income, you know, like at a certain point, you've made so much money, you've extracted so much value, like all of that money is just sitting on corporate balance sheets. So after 23%, after 10 million, or hell, make it 50 million, I don't care. Just at a certain point in your lifetime, once you've extracted that much value from owning something and selling it at the right time, it should be taxed. So, you know, what about a 40, 50% capital gains tax after you've extracted $50 million throughout your lifetime? That's my radical proposal. What do you think?
I mean, I love throwing out proposed tax regime changes to live on the podcast, a couple of hot live takes. Yeah. Some other fun ones I've heard is that we tax young people too heavily in the United States. So like, why do we have 18-year-olds filing tax returns to get refunds, right? Like, we should just have like speaking of exclusions, that your idea inspires, I think some countries you don't pay income tax until you're over 25, or your first $5 million of income is non-taxable or something like that. So people would just not have to worry about filing, and those that do make a lot of money and then so if you made $10 million at age 22, you would still file if there's a $5 million exclusion, right? Like now you're in the tax paying space. So there's all kinds of fun ways to skin the cat. It's a shame that Congress is sclerotic and will never get any of these ideas implemented. Instead, we're just going to no tax on tips, which is not a layup at all. I mean, as a former waiter, I love that. Like, I definitely needed the help. There's definitely a lot of blue collar people out there that get paid in tips that need the help for sure. But what about the kitchen staff? Like, what's going on behind the curtain in the back? Like, why are they not getting a tax break? Now, there is also one other thing, the no tax on overtime, which is equally complicated and interesting. The way that we define overtime in the United States, I think we have a lot of history on discussing this already, so that might be easier to implement. And there's a lot of regulation that's been implemented since the 60s and 50s on overtime, whereas tips seem less easy to quantify. So that, you know, is interesting. But then we get into this whole idea that it's an above the line deduction that can be claimed by taxpayers who claim the standard deduction. And you're just like creating a lot of complexity,
problems
here for people that do not have accountants and who accountants cannot afford to serve because they're, you know, working on hourly wages. A lot of those people just like use TurboTax or go down to Liberty Tax. I don't know. It just seems like you're adding a lot of complications for people that don't have the money. It just seems like very much like a let them eat cake situation. It's like Marie Antoinette,
like,
Donald Trump. These people
Yeah.
do not have CPAs to help them figure this shit out.
Yeah, and it's just a further disconnect between lawmakers and the constituents that they actually serve. You know, it's very clear that lawmakers, the constituents that lawmakers currently serve are corporations. That is very clear through this tax code, and large donors. Oh, the one thing, the estate tax, the giant estate tax exclusion that we got in with TCJA, which was about $12 million a person, is now going to be permanent at $15 million a person. That's too high, in my opinion. That only helps people that only helps the top 1%. That only helps wealthy people, and it adds to the deficit, period, full stop. Do not try to convince me otherwise.
It's a death tax, AJ. Nobody wants to pay a death tax. We need people inheriting $30 million tax-free because I think we need to bring back the aristocracy within the United States.
We have brought it back. We have an aristocracy. We have an oligarchy. You can buy anyway. All right, last.
I thought you were going to do a Prince Harry and Meghan Markle thing there for a second, which I was actually whatever keeps Meghan in the United States.
You're good. Okay. All right, let's one last final listener question. I like this question. This is from a Reddit question. How are you preparing for the coming storm? The next couple of years are likely to be rough, friends. What are you doing to preserve wealth and sanity? We are putting our vacation home on the market while we can get a good price for it and pile up some cash in the meantime. We hope to retire in 6 years, and the funds from the vacation home should help us move quickly when we see a deal. What are you doing while we watch the markets and supply chain take a tumble? Thoughts on this? How are you preparing for the coming storm?
I love. This is a tale as old as time. If you go back to the financial covers, when I say financial covers, I mean the magazine covers of Barron's in 1955, 1957, 1959. We've been crying wolf for 100 years. There is nothing you can do to escape volatility besides move to cash. And unfortunately, within cash, we do not have the returns that we get from exposing ourselves to risk that you get with the stock market. And you have to expose yourself to risk in order to get returns. So with that said, if you do want to escape volatility, you can also escape returns and move to cash. If you have enough money to spend on the rest of your life. Again, if I know when you're going to die, I can tell you exactly how much money you're going to need. We can move to cash, or we can draw down at an equal pace until we reach that day. Unfortunately,
assuming your lifestyle doesn't inflate at all, or we don't get hit with 9% inflation like we did in 2023. I take issue with the first sentence, which is the next couple of years are likely to be rough, friends. That is a person who is making an assumption. That is a person who is talking to people from a place of fear and is stirring fear. It's not likely. It's possible. The next couple of years might be rough. Are they referring to the 3 days of stock market dips in April that happened and that we've recovered to where we were when we started the year? Like, what is the definition of rough? Is it how you feel? It's when the headlines aren't super positive. The headlines are always negative. So this idea that you read something or you talk to your buddies and everyone's scared and everyone's moving to cash, and what was my voice last week? My 401k is down $200,000. Like, that is a choice to feel that way. You know, honestly, if you're looking down the barrel at retiring at 6 years, wouldn't you want to keep your cheaper vacation house and just move there? Like, isn't that your retirement plan rather than moving to cash and having to buy a shitty, expensive apartment somewhere with all cash to beat out a poor, young family because you've got cash because you're a boomer? Like, I don't know. Sorry.
That was a big assumption. I don't know how many boomers are on Reddit. I don't even. My mom finally got on Instagram. Which was huge. Really sweet. Huge. She liked one of my posts.
Oh,
incredible!
Welcome, Sherry.
Time to move to TikTok.
Yeah. So I mean, look, you can if you're scared, you can pile it. I don't know. I feel like this is just the key to financial independence is being able to tune out the noise and surrounding yourself with smart people who can gut check you. So I hope you're discussing this with your partner. I hope you're discussing this with your family, your kids, if you've got those, the people you're going to share your life, the people who are going to, participate in your life for the next 6 years. Like, I don't know. I don't like this idea of, I'm going to get a good price. I have decided this is a good price, so I'm going to put my home on the market. We don't know. We only know when something is a good price when we have hindsight. Like, we've got the people who way overpaid for their vacation homes during the pandemic, and they paid a 20 or 30% premium, but they have 3% 30-year mortgages. So it's kind of like you have to do what's best for you at the moment with a little bit of a view on the future. But I don't know. This is coming from a place of fear, and I do not think decisions made from a place of fear are good decisions.
100%. Yeah. I think this person thinks that they're playing chess when they're playing checkers, unfortunately. And a big job for us is to resist, speaking of what we discussed last time on the podcast, I had a tiger analogy and action bias. This person is expressing their action bias to run away from the rustling leaves, which was a 3-day dip in the market because of the tariffs. Now, don't get me wrong. You can't just pay attention. I mean, I think this person needs to read some books on stoicism or hire an advisor that stands in between them and moving to cash, because it's not just the movement to cash that can save you from a dip in the market. You also have to reinvest at the dip, right? Because you get out, but when do you get back in?
Well, that's a concern. So if you're all in cash, if this person's all in cash, what are they going to do? Rent? They're going to buy a house all cash when the market's like, I guess they're assuming they're going to time everything perfectly. They're assuming they're going to sell high and buy low, but we don't know that. We don't know if that's the case. All right. Well,
yes.
Weather the storm, folks. There may be a storm coming, and you know what? We got you. On the Liquidity event, we will help you through the storm. We will laugh our way through it.
Sticks the landing.
Thanks so much for listening. You can email us your financial problems at liquidityevent@brooklynfi.com. Leave us a voice memo at memo.fm/theliquidityevent. We will play it on the air, answer your questions. And finally, Stans can leave us a review if they want to be weird about it. We'll see you next week. Good night and good luck.